welcome back to the podcast. Today, we're diving deep into the world of corporate finance, and boy, do we have a lot to unpack. We're going to be looking at an earnings report from Adani Enterprises, and it's going to be a bit of a roller coaster, I think.
Absolutely. It's always a wild ride when we get into these detailed financials, right? So, Adani Enterprises, if I'm not mistaken, they're like the flagship company of the Adani Group. They dabble in a whole bunch of things from infrastructure to energy. It's like a huge conglomerate.
Yeah, exactly. They're into everything, like from airports and roads to even green energy stuff and, even mining. It's like they have their fingers in every pie. The report mentions a whole bunch of subsidiaries like Adani Airport Holdings and Adani New Industries. It's a massive network.
It really is. And so we're talking about a really complex business model that can definitely be challenging to analyze, right? So to start, the document mentions, well, it is an outcome of a board meeting from January 30th, 2025. And actually, they're presenting their unaudited financial results for the quarter and the 9 months that ended December 31st, 2024.
Okay, so this is kind of like a snapshot of how they're doing, at the end of last year. It's not final, but still gives a pretty good picture. So, where do we even start with this financial data? It's a lot to take in.
Well, let's start with the basics. We should look at the income statement first. It gives us the rundown on their revenue, their profits, how their costs and all add up. We need to check how much money they actually made, right?
Right. So revenue, profit, the good stuff. What are the key numbers then? I'm eager to see how they performed.
So for the 9 months ended December 2024, Adani Enterprises reported a total income of about 72,763 crore rupees, which is, actually a 6% increase compared to the same period last year. And their EBITDA, that's earnings before interest, taxes, depreciation, and amortization, went up by a pretty impressive 29%.
Oh, wow. Okay. A 29% jump in EBITDA. That's pretty solid. Shows they're managing their operations pretty efficiently, right? But what about the actual profit, after all the expenses are paid off?
Well, there's also some fluctuation when you go deeper into the profit metrics. Their profit before tax actually increased by 21% to around 5,220 crore rupees. But when you go down to the net profit attributable to the owners of the company, it's actually at around 3,254 crore rupees, which represents a 17% jump. The difference comes with tax expenses and their share of profit from joint ventures.
Okay. So it's a mixed bag of increases, but the profit jump is a little less in the EBITDA. I guess taxes and JV shares do take a big bite. So what about the expenses? How much are they spending on like materials and, the day-to-day stuff?
Well, when you look at their expenses, their cost of materials consumed went up to 6,120 crore rupees, and purchases of stock in trade are at 28,835 crore rupees. Then you have changes in inventories, which is at 1,518 crore rupees. But, one of the biggest line items there are operating and other expenses at around 21,263 crore rupees.
Yeah, those are big numbers. It seems like they're spending quite a bit on operations, but I guess, it's all in the name of making money, right? It also looks like they had some foreign exchange losses. That must sting a little.
Yeah, that's also there, and it's about 286 crore rupees. These losses can really impact the final results, especially for a company with lots of international operations. But now let's shift our focus to the balance sheet. That's where we get a sense of their assets, liabilities, and equity.
Okay. So the balance sheet is like their financial health report, right? Assets, what they own, and liabilities, what they owe. How does that look for Adani Enterprises?
Right. Well, if you look at their total assets, it stands at around 1,91,265 crore rupees, a pretty large number. And their liabilities, which are debts and all, come out to be around 1,38,295 crore rupees, which gives us a net worth of 52,969 crore rupees.
That's a lot of numbers. So they have a significant amount of assets, but also quite a bit of debt. How does their debt compare to their equity?
Well, when we look at the debt to equity ratio, it's around 1.35. It's useful to track this. And in past reports, it has been lower. It essentially tells us for every rupee of equity they have a debt of 1.35 rupees. So, it shows they're quite reliant on debt financing.
Okay, that ratio is something to keep an eye on. It's not crazy high, but it is definitely worth considering. And how about their cash flow? Are they bringing in more than they are spending?
That's a critical question. This document doesn't explicitly show all the cash flow details. It focuses more on income statement figures and a few ratios. It does mention a debt service coverage ratio of 2.63 and an interest service coverage ratio of 3.46.
Right. And so those ratios show, well, they're doing a good job at paying off debts and interests, right? So these coverage ratios are quite important, right? It's an indicator of how well they are handling their debt obligations.
Exactly, those numbers show they are, at least for now, comfortably covering their interest and debt payments. These are really important metrics for assessing their short-term solvency. Now, let's talk about ratios for a moment.
Oh, yeah, the fun part, all the different ratios they put out. Let's break down some of them. I'm keen to hear what you think they show about this company's financials.
All right, let's start with the operating margin, which is at around 12.82%. This actually tells us how profitable they are from their operations before considering things like interest and taxes. The net profit margin is at about 4.75%. Now, this shows how much of their total income ends up as profit after all costs.
Okay, so the operating margin shows they make a decent profit from operations, but the net profit margin is kind of small, right? I mean, there's that wide gap between these. So that means a lot of expenses are eating into it.
That's spot on. That also indicates that they have a lot of other overhead costs like interest expenses and taxes that are eating into their profits, right? It's kind of like, they're good at making the product, but then all the overhead reduces their net income.
Right. It's like if a bakery is great at making bread, but then has to spend a lot on rent, utilities, and taxes, all that impacts the bottom line. Now, what about those turnover ratios?
Well, the debtors turnover ratio is around 9.30, which means that they're collecting their payments from their customers approximately 9 times a year. And the inventory turnover ratio is around 4.50, meaning they're clearing out their inventory about 4.5 times a year.
Okay, so that shows their efficiency in handling receivables and inventory. They seem to be making sales fairly quickly, but maybe not as fast for inventory, I guess. Now, these are just a few ratios out of so many in the report.
Right. And this report also throws in some additional info like they've completed a qualified institutional placement, QIP, and allotted over 1.4 crore equity shares and raised quite a bit of money doing so. It's basically a way for companies to quickly raise capital.
Oh, yeah, I saw that they raised like 4,200 crore rupees, right? So that explains the increase in their paid up equity share capital. But, they are also having a few, what's the word? Business realignments. They have a sale of power trading business.
Right. There's a business transfer agreement in place for that. They're selling off their power trading business, which they are classifying as discontinued operations. Also, some subsidiaries are also merging or being sold off. It seems like they're restructuring things.
Yeah, it seems like they are streamlining their operations, focusing on key areas. It's like they're adapting to market changes, trying to optimize and all. Oh, also that short seller report from 2023. It looks like the Supreme Court is handling that, or SEBI.
Right. And there's also the Mumbai International Airport thing with investigations and legal proceedings ongoing. It's a pretty significant issue, and their auditors have actually given a modified conclusion because they don't have enough evidence. And that is definitely a big red flag.
Yes, those are definitely some major things we need to be mindful of, And there are ongoing issues and litigation with other airport subsidiaries. It's a complicated situation, right? Now, what about their outlook and recommendations?
Well, based on all this, the document also includes a media release. It notes a 29% increase in consolidated EBITDA. So it paints a pretty rosy picture of growth in the incubating businesses like green hydrogen and airports. The management emphasizes this strong performance as a key highlight.
Ah, right. It always looks a lot more optimistic in the management's words, I guess. But, considering the high reliance on debt, the ongoing legal issues, there are risks that investors should be aware of. Disclaimer, you advise investors to check with certified experts before taking any investment decisions.
Absolutely. These issues add a layer of uncertainty, and that needs to be carefully considered by anyone thinking of investing. It also looks like they have a pretty solid plan in place for their KIP proceeds. They are allocating it to the green energy projects and I think airports as well.
Yeah, and they're even repaying some borrowing. So they're not just expanding, they're also taking care of their debt a little. And this is a good time to remind our listeners to like, share, and subscribe to our channel for more analysis like this.
Definitely. So, as a wrap up, Adani Enterprises is a massive company with a diverse portfolio, right? They show growth in key areas, but also there are definitely some risks that investors really should be aware of. I mean, it's a company with lots of moving parts.
Yeah, lots of moving parts is an understatement. They've got some major positives like strong revenue and EBITDA growth, particularly in their emerging businesses. But also, there are those risks tied to high debt, ongoing legal issues, which are a big concern.
And it seems like the company has a clear focus on their key incubating businesses like airports, data centers, and renewable energy. So, long term wise, their focus is there. They seem to be restructuring things to streamline and all.
Yeah, it definitely feels like they're adapting to the market, but the road ahead will depend on how well they can manage those risks and continue this growth momentum. It really leaves a lot for investors to think about, I guess.
That's it, a complex picture of opportunity and risk. So, what do you think? Should they be focusing more on paying off debt or should they double down on their growth projects?
That's a really good question. It's a balancing act, isn't it? Thanks for breaking this report down. That was actually quite fun.
Always happy to dive into the details. And it's all about understanding the numbers so that we all see the big picture, right? So until next time.